Good afternoon, ladies and gentlemen. Welcome back to this week weekly market review. We have just finished the first week of the second quarter, and last week the big macroeconomic data was the non-farm payroll number. And the previous week we talked about the dot plot and the projection of the Fed rate cuts going to the end of the year. And of course, Mr. Gerald today joining us today again to share with us his views, his opinion, and give us some highlights of what happened in the markets. Gerald, what do you think of the non-farm payroll number and the movement in the rate cut probabilities?
Yeah, so quite a number of macro data points that we saw in the past week. The jobs data in the US was definitely something that a lot of investors were looking out very closely for, given that it provides an indication on the health of the US economy. The jobs data was much stronger than what most people expected. So that had impact on the market as well as the expectations going forward as well. That's something that I'll go through in more detail subsequently. And I think before we start, just wanted to go through the usual disclaimer that today's session is for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming Ask SIAS session that is on the 17th of April. This is a special edition that is open to everyone. So if you have got any questions for Sunny and myself, do go to this website to be registering for the upcoming Ask SIAS session. Okay, if you find the weekly market review helpful, do leave us a review on Google via this link. And if you'd like to consider joining SIAS as a member, do visit this website, and the membership would cost $12 per year or only $1 per month. Okay, so we mentioned earlier that there are quite a number of developments. This has actually impacted the market in different ways. I think first and foremost, if we look at the S&P 500, we see a slight correction, down 1% to just above the 5,200 levels. Okay, within this, there was a bit of divergence where the Dow Jones did a bit better and the Nasdaq actually performed slightly worse. Okay, closer to home, we saw that the STI came down slightly as well, down about 0.2%. So all in, I would say a mixed week for the global stock market, driven by the sentiment after various economic releases were announced. The key data point that really came out is the US jobs data. I think what it reflects is that the labor market in the US is still very strong. Okay, so in total, more than 300,000 jobs added in the month of March. Okay, this was above expectations of about 200,000. And if you look at the chart that I put up here, effectively the highest level over the past 1 year. Okay, so I think effectively what this is telling us is that despite the very high interest rates, the US economy is still very strong and is adding a lot more jobs, which reflects that the economy is still very healthy. Okay, so how does this translate to the stock market? Number two, we also see that separately from the strong jobs data, there are now concerns that inflation will remain sticky. Okay, the other big move last week was that we saw oil prices moving back up to above $90 per barrel once again. Okay, so this is the chart of Brent crude oil. We see that it has actually gone up above $90 per barrel and the highest level since November last year. Okay, so what is driving this move up in oil prices? Number one, you have got the global economy still doing fairly well. So that has helped to drive up demand for oil. At the same time, if you look at the supply cuts coming from OPEC, that is actually leading to this supply and demand mismatch, which is then driving up the oil price. And then at the same time, you have escalation in terms of the geopolitical tension, which is helping to boost the oil price as well. So what does this mean when we put the two together? Number one, you've got inflation that is stickier than expected. Number two, you have the US economy still being very strong. Overall, it is leading to expectations that, okay, maybe the Fed might not be able to cut interest rates as aggressively as previously expected. And that is what we see here in terms of the US government bond yield. Now at the 10-year is now at above 4.3% again, which is also the highest level since late last year. Okay, so I think overall the picture that we are now seeing is that while investors are still expecting that the Fed might cut interest rates in June, because the US economy is still very strong, because inflation could be stickier than expected, what we might end up is that the interest rates might still remain at a fairly elevated levels, even after the rate cut that is coming through. Okay. So that is the macro picture. We see that in terms of how it is impacting individual stocks as well. In terms of the top gainers for the STI, we have got Seatrium up by 6.3%. We talked about Seatrium's Investor Day announcements in the previous weekly market review. So if you missed that, do go back to have a recap with our previous weekly market review. Okay, the REITs are showing a mixed performance after the volatility in the bond yields that we see. We've got within the top performers, Mapletree Pan Asia Commercial Trust up close to 5%, and Mapletree Logistics Trust up 2.1%. In terms of the worst performers, it is a mixed bag as well. We have got Singtel down by 5.1%. After they denied the press reports around a potential sale of their Australian subsidiary, Optus, once again last week. Okay, so if you missed the discussion around Singtel and Optus and what they're doing to transform the company, once again, it is something that we discussed in the previous weeks, and you can go back to the previous weekly market review to get a recap. Okay, the stock that I wanted to share more about today, CapitaLand Ascott Trust, which is a name that we get queries about from investors, given that it is one of the largest hospitality REITs that is on the Singapore Exchange. Okay, what we see in terms of the share price is that it has been fairly resilient. If you were to compare them with some of the other REITs. Okay, so if you look at the year-to-date performance, started the year maybe close to $1, now at about 94 cents, despite the concerns around interest rates being higher for longer, which has generally impacted the sentiment towards the Singapore REITs. Okay, so if you are not familiar with CapitaLand Ascott Trust, it is the largest lodging trust in Asia Pacific. They have got more than 8.7 billion worth of assets, with 106 properties across 45 cities in 16 countries. Okay, so what we see here is a fairly diversified mix of assets, where while they have got properties in Singapore, we see that there are properties in other parts of Asia, in Europe, as well as in the US. Okay, so for many investors in Singapore REITs, one of the key issue that was faced last year is that because of the higher financing cost, the distributions largely came down in 2023. We saw that there were only 6 REITs that managed to raise their distributions last year, of which CapitaLand Ascott Trust was one of them. Okay, so if you were to look at the second half 2023 performance, they managed to raise their revenue as well as their total distribution. And what we saw is that the distribution per security actually went up by 14% compared to the previous year. Likewise, if we were to look at the whole of the full year 2023, we also see this increase in revenue as well as distributions for the full year. Okay. Okay, so what we have learned is that the hospitality REITs generally saw a recovery in 2023 with the global travel recovery. And what we see here, which was a question that we commonly get as well, is that what is the key metric to track for hospitality REITs? So the key thing that I'll start to look at is actually the revenue per available unit, which is effectively how much they are earning per available room in some of these lodging facilities that they might have. So by the fourth quarter of 2023, it is back to $161. There's an increase of 4% compared to the previous year. And encouragingly, it is now above the pre-COVID levels. Okay, so while we saw this very sharp correction during COVID, things have gradually recovered, such that now as a portfolio basis, it is above where we were prior to the pandemic. Okay, so we can break down to the performance of the different assets. And what we see here is that there has been a strong recovery in some of the markets, like in Japan, in the US, and that has helped to drive up the revenue as well as help to support the distributions. So for most of the markets that they are operating in, they are already at the revenue per available unit above where it was prior to COVID, except for two markets, which is China as well as Vietnam. Okay, so we saw earlier that the overall portfolio revenue per available unit is at 103% of the pre-COVID levels. And it is really in China as well as in Vietnam that it is still below, which is dragging down the overall portfolio performance. Okay, so while you might actually see some of the REITs being able to grow their distributions, being able to grow their revenue, they might be impacted by other things like higher financing costs. So that's the other element that we need to keep a lookout for in terms of whether it has got a good financing ability as well as capital management to be able to bring about an increase in distributions even after the revenue is increasing. Okay, so what we see here is that the gearing level of CapitaLand Escort Trust at about 37.9%. Okay, so that gives it about 2 billion of debt headroom if it actually wishes to be, say, making potential acquisitions. But what actually is worth noting is that the cost of borrowing is fairly low at about 2.4% per annum. So this is actually something that has helped the REIT to be able to support the distributions, given that they do not so far have a very sharp increase in the financing cost. Okay, the next thing that we'll look at is outside of the ongoing portfolio of assets, what is the REIT actually doing to be able to help support the distributions? And this is where the active asset management actually comes into play. And I think what CapitaLand Escort Trust is doing here is that they are looking at opportunistic divestments to be able to unlock value. They actually divested about 260 million worth of mature assets at a premium to book, and that's actually helped it to recycle the capital for it to be deployed to other users. Okay, so with some of this capital, what they want to be doing is to invest in quality hospitality and longer stay properties, which can potentially generate a higher yield compared to some of these assets that they might have divested. So what this means is that overall, even within the existing portfolio, there are different measures that are taken to be able to enhance the yield. The other thing is to perform asset enhancement initiatives. So what this effectively entails is that for the portfolio, what can they potentially do to make it something that can earn potentially a higher revenue per available unit and actually generate a higher yield for the REIT. So there's a pipeline of 8 asset enhancement initiatives, and all of it is intended to uplift the properties and create this additional tailwind beyond the more broader travel recovering that we are seeing. Okay, so all in what we see here is that the distribution per stapled security has actually recovered over the past 3 years, from about 3.03 cents in FY20 to 6.57 cents in FY 2023. Okay, so this is really a result of the recovery in global travel, which has helped to uplift the revenue, as well as the various capital management initiatives, the capital recycling initiatives, that's also helped to improve the distributions. Okay, so if I were to look at the valuation of CapitaLand Escort Trust now at about 0.8 times price to book, so still trading below the book value, and I think that is probably in line with the historical average, where it has been trading around this band outside of the COVID period, where it traded to more depressed levels. Okay, and if I were to compare CapitaLand Escort Trust to some of the other hospitality REITs, these are some of the key metrics that I will keep a lookout for. Firstly, what is the percentage of Singapore as a part of the total portfolio? So for CapitaLand Escort Trust, I shared earlier that it is a diversified hospitality REIT. And with that, Singapore just contributes about 17% of the total portfolio. But in contrast, we've got some of the other hospitality REITs, such as Fraser's Hospitality Trust, Far East Hospitality Trust, that has Singapore contributing more of their overall portfolio. So depending on what you're looking for, some may prefer a pure Singapore exposure because maybe we believe that Singapore's tourism sector will recover very strongly in the coming years. Or we might prefer something that is more diversified to allow us to be able to smooth out the volatility from specific markets. Okay, in terms of the DPU growth in 2023, we see a range, but the encouraging part is that for hospitality REITs, most of them actually saw this recovery coming through in 2023, driven by the global recovery. Next, we can look at the gearing ratio, which actually provides us with an indication of how much debt that the REIT actually have. And for most of the hospitality REITs, we see that their gearing ratio is below 40%. So that provides some room should they actually want to be picking potential acquisitions, or if they want to be keeping their overall borrowing costs low, that is something that does help as well. Next, we can look at the valuation as well as the dividend yield that the REIT actually offers. And we see here a range based on what they paid out in the previous financial year of between 5.3% to 7% across this hospitality REITs. Okay, so having gone through CapitaLand Escort Trust, we are going to look at a few things to look out for in the market ahead. So we mentioned earlier that we see a big volatility around the US government bond yields, and that is probably something that is likely to continue, given that we have got a key macro data point that's come up this week, which is the US inflation data. Okay, outside of that, in Singapore, we have the MAS monetary policy statement this week, and also the start of the earnings season in the US, with JP Morgan and Citi reporting their results on Friday. So with that, I'll hand over to Sunny, who will actually tell us what we can look out for in terms of the technical indicators.
Hey, thanks, Gerald, for that sharing on the Singapore market updates. I would do a recap on the global side of things. Some key numbers that I want to highlight would be the probability on the CME Fed Watch 2 on the rate cuts. Previously, we are looking at the June rate cut around the 60% level. It has now come down to the 50% level. So that is something that you might want to watch out for going forward. Becomes a 50-50 situation very soon. So that is something that the market might want to consider. On the economic data, of course, Gerald mentioned the non-farm payroll earlier. So just to give you the numbers as well, the previous reading was revised to 270,000, and the latest one we have is 303,000. Unemployment rate also dropped by 0.1%. So this is a very strong job number that caused the probability of the rate cuts to come down for the June period at least. So next, I will round up the technical developments in the indices globally. Let's go to the STI first. So last week we talked about STI touching a new year-to-date high on somewhere on the 27th of March. And then this level now around the 3,250 points level and above is a very strong resistance level coupled with the double top formation that we observed earlier. And we had a very good run of 4 consecutive weeks of winning weeks for the STI index, hence a very good run up in the March period. But the first week of April, we have a bit of a pullback. So that means there might be some opportunities that might come along over here. But as of last week, we stated that probably the support level will come around at least during the 200 days exponential moving average line, which is the red line that you see here. That's around the 3,214 points level. Sorry, that is around the 3,180 points level, and the STI is now at around 3,214 points level. So still some gap before we touch the first critical support level for the STI index. Indicator-wise, you can see that MACD indicator has significantly converged towards the signal line, and the last few trading sessions, at least the last 5 on the last 5 trading sessions last week, the momentum of the uptrend has significantly become lower, and we will probably see a crossover of the MACD line below the signal line this week, and that could signal or confirm a change in direction of the 1 month run up that we saw in March last month. The RSI has also started to weaken. The crossover point of the RSI, I would say, would be the 14 days moving average. Somewhere at the middle of last week on Wednesday, you can see that the RSI actually crossed below the 14 days moving average of the RSI indicator. So that means that we are the latest reading now at 53 is getting weaker and weaker as for the past 2 weeks at least. So that means momentum is also starting to get weaker for the STI index. Hence, both indicators are telling us that we are not likely to see a bounce up again to the year-to-date high that we saw on 27 March anytime soon. And more likely, we are going to see the STI pull back further due to weak momentum and a change in direction according to the MACD indicator. And that means we will still reiterate the support level at least around the 200 days moving average at 3180, and even lower, that would be the support zone that we look in to get into the STI should STIs retrace further to this area. Okay, next let's move to the US indices. So US indices, this is the development on the US Dow Jones index. We had a nice green candle on Friday, but as you can see, Thursday was actually a very drastic day for the Dow Jones index. At least Thursday, we are down about 530 points or 1.3% around those regions. And this is one of the worst day that we have on the Dow Jones index for this year. And Friday bounce, of course, negates those retracement a little bit. But then you can see that the bounce back is due based on the strong non-farm payroll data. So at this moment, we still do not know whether it will continue to test the all-time high again. But like we said earlier, if the Dow Jones index crossed below the 20 days moving average on the longer term, on the longer trajectory of the outlook of the market, I think we are still positive. Hence, when it retraces back down to the 50 days moving average, that is the opportunity that we should be getting in on the Dow Jones index. So let's say if the markets were to come down this week against to this level, which is the blue color line that you see here, the 50 days moving average of the Dow Jones Industrial Index, that would be around the 38,700 points level. That would be a good entry point for the Dow Jones Index to at least play to the year-to-date high or the upper bound of the Bollinger Band at 39,910 points. Indicator-wise, definitely we are into the negative zone already. You can see MACD indicator, the negative reading now is at negative 91, and you can see the MACD line have crossed the signal line on Tuesday last week. So if it crosses below the zero baseline, the pullback might come back down further. So if you have a first entry on the 50 days moving average on the charts around the 38,700 level, the next level that you'll be looking out for will be the amber line that you see here, 37,795 points, or I would say the average between these two levels will be the 38,000 handle to look out for the Dow Jones index to see if there's a pullback opportunity to get back into the index. The RSI's wise, the RSI on last Monday, we has already broke the 14 days moving average on the RSI. It has come down. We see a bit of bounce on the Friday, but the latest reading at 47 is still below the 50-point neutral mark. Hence, momentum is still weak right now for the Dow Jones Index. So I view this as a short-term pullback and an opportunity for us to get back in on the Dow Jones Index. So the level to look out for will be around the 50 days moving average and the 100 days moving average, somewhere averaging around the 38,000 handle. Next, on the S&P 500, same thing. We have a negative day on Thursday, but we have a bit of bounce on the Friday. So we are now using the 20 days moving average on the S&P 500 as a support, because S&P 500 managed to close above that level on Friday. But you can see the MACD indicator is also starting to come downwards. But on Friday, we do have the momentum starting to sort of recover. So the downward momentum is not as strong as compared to the Dow Jones Index, and the RSI also speaks the same tone, with the reading at 5 points above the 50-point neutral mark. So S&P 500 is in a slightly better shape. As usual, where would be the support level between the 20 days moving average? That will be one of the entry points that you look at. And historically, at least for this year, we can see that the 20 days moving average has been providing a very strong support. And if it comes down to the 50 days moving average at 5,075 points, that would be a clear level that we should be getting into the S&P 500 index around this level. Okay, next, let's move to the tech-heavy Nasdaq Composite Index, which is the best performer on Friday. Okay, we have a big down day, down 1.4% on Friday, but on Friday we recovered 1.24%. So that is a good recovery. Same thing, the 20 days moving average continued to be a very strong support for the Nasdaq Composite Index, waiting for the 50 days moving average to be tested, and that would be the call, at least for some of the technical traders to look at to get into the Nasdaq Composite Index. On the MACD indicator, we have a negative reading. We can see the MACD line is coming down, and you can see that the trajectory of the MACD line is actually starting to move sideways instead of pointing directly downwards. The angle of attack is actually starting to smoothen out, and looking at the momentum, it is getting also a bit less aggressive, moving downwards and recovering a little bit. On the RSI, the 52-point reading, the latest that we have, does not seem to give us any signal because it's very close to the 50-point neutral mark. So I think for the Nasdaq Composite Index, the 20 days moving average would still be the pivot level to look out for. Upper bound and the lower bound of Bollinger Bands are key areas of support and resistance that we can look out for. And on the support side, if you're playing the longer term game, the lower bound of the Bollinger Band would have found confluence with the 50 days moving average as well, and that would be a very strong support level for the Nasdaq Composite Index. And that is all I have for this week. Gerald, anything to add?
I think thanks for the sharing. Quite a number of macro data points that are moving the market at this point in time. I think given the volatility that we see for the US government bond yields, definitely the inflation number that is coming up this week will be closely watched, because that will really give us an indication as to whether we will see the first rate cut coming through in June or not.
Yeah, I totally agree with that. That is after the non-farm period, that is the second macro data point that we were looking at. And if we look at the projections on some of the consensus right now, the core inflation is expected to come down a bit lower. I hope the consensus is true. If the consensus is not true, then maybe the pullback that we saw last week will extend a little bit further. But on the longer term wise, going to earnings seasons, we are looking at corporate earnings performing better or justifying their valuation. That would means that our equity markets will continue to perform further into the year. Okay, I think that is all the time that we have for you guys this week. As usual, do remember to stay safe and trade safe, and we'll see you again next week in the next weekly market review. Thank you.